So the last time we talked, introduced a few concepts. I introduced the concept of supply and demand, the concept of fair value gaps and imbalances, the concept of what has been introduced? Market structure, order flow. Can you hear me? Can everybody hear me?
Liquidity.
Liquidity, inducement. Now, what we had the last time, or after the last video, was just introductions and then definitions of concepts. Okay, but a few of us were in so much haste that we got on the charts and began to confuse ourselves. Okay, I understand the zeal and the passion, but then zeal and passion is useless when it is not backed up with direction. You only end up with frustration, lots of frustrations, okay? So let's take it one step at a time. Do not be in a haste, just follow the courses and the classes one step at a time. We're on market structure, and then market structure is supposed to take this month and probably next month, okay? Because like I mentioned, we'll be dealing in-depthly with all of those things, okay? And today we'll be talking about, what do we have? I have a lot I'm supposed to share with you guys, like a lot.
Sorry, are you recording this one?
Okay.
Okay.
Yeah, we'll talk about. Let me check. Yeah, we're supposed to talk about character of major liquidity. We're supposed to talk about points of interest, talk about structure, talk about price model, and then talk about inducement. Okay, 5 of them, right? 1, 2, 3, 4, 5, 5 of them. And they're supposed to take us for 5 months, 1 month each. Okay, because of the depth of what we would be talking about. So the first one, in case I forget, somebody tried to remind me. Okay, character of major liquidity. We'll be talking about point of interest. We'll be talking about in-depth market structure. We're talking about market models and inducement models, as well as entry models. And then we'll be talking about the general concept of inducements. Okay, inside of inducement, we talk about liquidity. So today, still on market structure, I may be introducing a bit of price model, or we could just stay on major liquidity. So let's just talk, and then we'll move from there. Let's see. Exactly 40 minutes, I want to be off this call, regardless. So probably I will 40 minutes, and then we'll do questions and all of that in 10 minutes, and that'll be all for today. Okay, so can we make progress now?
Yes, sir.
All right, then.
Yes, sir.
Yeah. Okay. All right. Now, I talked about market structure the last time, and I explained the fact that I was introducing the concept of weak highs and strong lows, and weak lows and strong highs, if you all can remember. All right. Okay, so today we'll try to make some progress and see what we can achieve within the world. I'll be talking about market structure, and I'll be talking about external and major liquidity inside of market structure. External and major liquidity inside of market structure. Now, when you hear liquidity, what comes to your mind? Okay. Liquidity just refers to, let me do it here. I hope I spelled that correctly. Okay, liquidity just refers to money. Liquidity refers to money, but when it comes to the charts, when we are talking about money, we are talking about orders, where we have bulk orders or tons of orders in the market, or any order at all. Okay, because the only way we have money in the market is when we have orders in the market. Okay, order transcends to money in the market. Okay, so when we talk about liquidity, we are talking about orders. We're talking about money. Okay, so we're talking about market structure, and it has to relate with external and major liquidity. Okay, now every high and every low has liquidity. Okay.
Okay.
Every high and every low has liquidity. Okay. For an uptrend and for a downtrend, I'll try to see how I can get this done pretty fast. Now, the highs of your uptrends are called external liquidity. Okay, so the highs of your uptrend, the higher highs on your uptrend are called external liquidity, while the lows of your uptrend are called major liquidity. I'll tell you why in a minute. Okay, the highs are called external liquidity and the lows are called major liquidity. Okay, and on your downtrend, the highs are the major liquidity, while the lows are the external liquidity. Major liquidity, external liquidity, and so on and so forth. Now, like I said, liquidity refers to orders, refers to money, refers to positions, refers to buy limits, sell limits, whatever you can call them. Okay, because that is how price moves. We move by creating liquidity. Create liquidity, induce liquidity, create liquidity, induce liquidity, create. That's everything that happens on the chart. Okay, now why are they called major liquidity and external liquidity? Now, if you're writing, you can write this down. A major liquidity is not expected to be run over, or it is called a major liquidity because it is supposed to be respected. So you can choose to call it major liquidity or respected liquidity. It still brings in the concept of a strong low and a weak high. Why is it called a respected or major liquidity? It is because in an uptrend, the people who fuel price, okay, or the right trading orders are inside of here. Okay, the right orders are inside of here. The orders that actually cause the buy moves are inside of here. Okay, so for those trading currency pairs and all of that, what should happen if the banks who put this order come down and then liquidate the order? The banks will be in a loss, the house will be in a loss, and the house never loses. Okay, the house never loses. The idea of the house losing does not exist. So hence, they must protect this liquidity. By liquidity, I mean the orders that are inside of here. By the orders, I mean the money that is resting inside of here must be protected. Okay, so it automatically makes this a major liquidity. So in an uptrend, every higher low is a major liquidity. In an uptrend, every higher low is a major liquidity. Every higher high is an external liquidity. And the idea of external liquidity is that we are supposed to violate it, liquidate it, run through it, induce it, whatever you choose to call it. Okay? So it is an external liquidity because it is expected to be run over. So you can call this expected liquidity and call this respected liquidity. That is what I call them on my markings. That's Billion Banks edition. Okay, so you can call this expected liquidity because you expect price to what? Take them out. And you call this respected liquidity because price is not expected to take it out. Price respects them. Price respects them. Price respects them. Now, when I begin to talk about entry models, you see that price actually is supposed to come into this level, okay, and bounce off without violating this level, okay, because that's where we have our demand on the buy trend. Okay, so that's supposed to be okay, I'll try as much as I can not to use the terms I will be using on the long run. I don't want to be way too fast so I don't end up confusing you the most. So let's just go with it one step at a time. Okay, one short step. I'm trying to look for a tool I can use for proper illustration. I think it's only on TradingView for currency pairs, but let me check. All right, I can't find it. Probably I'll check some other place. All right, okay. So like I was saying, on the uptrending markets, the higher lows are your major liquidity and the higher highs are your external liquidity. The idea is that price is not supposed to run through an external liquidity because it has to be respected. Okay, why the idea for this is that price has to violate it because it has liquidity that needs to be taken out. So this is external liquidity and this is a major liquidity. Now the same thing applicable to reverse is just the case for your downtrending patterns. On your downtrends, we have lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, or strong highs and weak lows, strong highs and weak lows, strong highs and weak low. Your strong highs are your major liquidity, while your weak lows are your external or expected liquidity. Why? Because price is supposed to run through them. Give me a minute. All right. So these highs, your strong highs are your major liquidity, while your weak highs, your weak lows rather, are your expected or external liquidity. And I believe that I have properly communicated the idea why they are called that way to you. Everybody understands that so we can make progress.
Yes, sir.
Yes, sir.
All right. Now, let's quickly deal with characteristic of major liquidity. Characteristic of major liquidity. All right, before I get to that, let's talk about two types of structure. Let's do that quick. Two types of structure. Okay. So I can clear this out right now. Let's do two types of structure. Oh, okay, that's different. Let's say yeah, two types of structure. All right. Now, everything that happens on price, okay, everything that happens on price is structure. We have simple structure, we have complex structure. Okay, we have simple structures and we have complex structures. So let's talk about the simple structure first, and then we'll talk about the complex structure. If somebody time me to know when it's exactly 9:30. All right, good. Now, what is a simple structure? A simple structure is when you have price creating clear higher highs and higher lows. Okay, I'll introduce an additional one to this structure. So somebody remind me. I just remembered something. Okay, simple structure. We are forming clear higher highs and higher lows, or lower highs and lower lows. All right, simple structure. Okay. I'll try to introduce compound structure somewhere along the way. Okay, I'm introducing compound structure, complex structure already. And okay. Whose fan wants to fall like that?
I thought it's a washing machine, sir.
Okay. May that fan not fall. All right. Now, a simple structure is when we have price printing clear, lower highs and lower lows, or higher highs and higher lows. Okay, I'll be dealing with two concepts inside of this structure, so just flow with me as much as you can. Okay, I'll try to introduce something else from this point that would give us a continuation of what we are doing. Okay, I will introduce something called the range structure. Okay, let me just have it here. Range structure. Okay. Just kind of aesthetic. So yeah. Okay, so the major structures are simple and complex structure, but I'll have to introduce range structure for a few reasons. All right, so a simple structure is where we have price creating clear higher highs and higher lows, higher highs, higher lows, higher highs or lower highs and lower lows, depending on the trend we are forming. Now, this is a simple structure for a downtrend. Okay, the simple structure is what I have here on my left. Simple, very clear structure. Everybody knows this. Okay, now what determines a complex structure is where we have a combination of shallow corrective wave and deep corrective wave. Shallow corrective wave and deep corrective wave are what forms a complex structure. Okay, now what is a shallow corrective wave? A shallow corrective wave is when price pulls back inside of the range. Okay, when I say range, I mean this first place here where we have this high. Okay, that signaled our first break of structure that we are going to sell. From this place to this point where we had our next change of character or break of structure that was supposed to serve as an introduction to a buy. Okay, so the range is from this high to this low. Our range here is from this one to what? To this one, or this one to this one. Okay, is our range from here to here is our range, here to here. Okay, so simple structures when we have price printing out clear structures, lower highs, lower lows, or higher highs, higher lows, or weak high, strong low, or strong high, weak low, as the case. Okay, now the structure becomes complex when we are still in the trend, but price gives us a change of character and then pulls back the first time to mitigate a demand level somewhere inside of the internal structure. Oh, I just remembered something I need to add to it. Internal structure. Okay. All right. We'll do that. Just work with me on this. Okay. When I say internal structure, I mean every other low and high forming inside of the range. Every other higher high and higher low, or lower high and lower low forming inside of the range. The range is the start of the trend to the next area of the trend before we have a break of structure. Okay. So whenever we break this structure and retest and continue downward, we have left this range. So this here, right here, so what here is a range, or let me call it here. Let's use here. Let's assume, let me take this out. Okay, let's assume there was some other downtrending leg here. then price changed at this point, okay? So our range becomes from here, right? From here to here as a range, and then from here to here as a range, okay? So internal structure refers to everything happening inside of the range, okay? Though internal structures can be split into minor structure and major structures, okay? But then I will not go minor structure and external structure inside of internal structure, rather. I will not go through that now, so I don't confuse you anymore. We'll do it one step at a time. So this here is our internal structure because it is inside of the range. Please have that at the back of your mind. An internal structure is the formation of market structure, higher highs and low or lower highs and lower lows inside of a range. Okay, so when price gives us a change of character and gives us a shallow pullback. Now, a shallow pullback means that it is retesting internal structure. If you watch the last video I posted, I told you guys that a higher time frame run is a lower time frame trend. True or false?
True.
All right. So this thing here on M15, let me give you an illustration of what it will look like on your H4. You'll possibly see, let's do this like this, and trace the trend. Okay. All right. So this is what you would see on your major time frame. Okay. On your higher time frame, 4 hours or any of that, you will not see it broken down like this. It will just look like simple runs. Okay. So like I was saying, a complex structure is a combination of shallow corrective wave and deep corrective wave, which is what we have here. Okay, so shallow corrective wave is when price mitigates internal structure, or when price pulls back to internal structure, either a demand or internal structure, and then comes back, but continues again to the upside to mitigate primary point of interest. I'll introduce all of those concepts I'm mentioning as we make progress. Okay, so it goes back to mitigate our primary zone, or our primary structure, or primary major structure. Okay, you know, I talked about major liquidity, I talked about external liquidity, right? So when price goes back to mitigate major liquidity, we have a deep corrective wave. Now, look at it here in the 4 hours. So we don't confuse ourselves. We'll get back to this. But look at it here with the eyes of looking at the 4-hour time frame. We had price moving, impulsive correction, and so on. And then we had this pullback here, right? If you're on the 4-hour time frame, you would not know what price had retested here. Okay, you see something like that on your 4-hour time frame. You see a retest that you do not know what price actually retested. True or false? Okay, and you have to go to your smaller time frame and begin to see that there are internal structures inside of here that we are retested. Okay, so the retest to this level is our shallow corrective wave. Okay, now price retests that level but fails to continue with the trend. If price comes here, retest this level and drop, then our complex structure is invalidated because it shows the formation of normal lower highs and lower lows. But failure to do that and price mitigates this level, comes here and then form liquidity, internal liquidity, okay, has been formed here. Internal liquidity because it is inside of the structure, inside of the range. What is the range? The range is this point, right? The range is this point to here, this point.
That point, yeah.
Internal liquidity has been formed, okay? Or inducement, but this can be 2, it can be 1, depending on what. When I teach characteristics of a major liquidity, I'll break down all the forms of internal liquidity we can see inside of this area. Okay, 926. All right, so when we have price give us a shallow corrective wave, fails to break through structure, fails to violate our weak high, okay, because this is our strong low. It is a strong low because it took out this high, giving us our first break of structure. That signifies that we are on a downtrend. Okay, so this was our first break of structure to signify a downtrend, and this was also our first range. Okay, so price breaks out of this range, comes back to this level, mitigates either resistance turn support or mitigates a base candle or any of that inside of here and goes back, but fails to take out the next area that is supposed to be an external liquidity. Okay, instead of that, we form liquidity, internal liquidity inside here and continue to the upside. So mitigate our major liquidity, a zone inside of our major liquidity, and then continues bearish. Once we continue bearish from this zone, automatically this structure becomes a what? Complex structure. Does it make sense?
Yes, sir.
Yes. Yeah.
Anybody confused?
No,
Any
sir.
confusion? All right, great. So this is the illustration of what it should look like on your 15 minutes time frame. Higher highs, higher low, higher highs, higher low, lower highs rather, and lower lows, lower highs, lower lows, internal structure, and then price change character went up. Okay. Don't forget, created some sort of inducement. Okay, here, because it had not yet mitigated the point, and then buyers came to the market. This was only to retest this and then continued here to the upside. Mitigated an internal structure, still giving us what? A shallow pullback, okay? Because our range was somewhere around here, okay? Break out of that range. And then price continued and then went back into the area to mitigate our actual major, what? Liquidity. And then we began to drop from there. Automatically, this becomes a what? Complex structure. Why, when we have clear forming of higher highs and higher lows, or lower highs and lower lows, becomes a simple structure. So I'll go over it again. A simple structure is the formation of clear higher highs and lows, lower highs and lows, or weak highs and strong lows, or strong highs and weak lows. Why a complex structure is a structure that has both a shallow corrective wave and a deep corrective wave. Okay, my 40 minutes is exhausted. I think we can take something very quickly before we answer questions. Now, a range structure. What is a range structure? Now, this is what a range structure looks like. Okay, very quickly, I'll use the same diagram. Now, price breaks out of the range. Okay, price breaks out of this range. Okay, and begins to form a new structure that takes it away from the zone. And mind you, without liquidating or retesting anything inside of here, okay, forms a range structure, right? Creating liquidity, okay, and then takes price away from the zone. This formation of price that happens outside of our external and major structure becomes our range structure. It is called the range structure because it is outside the range. Inside the range, it will be internal structure. Outside the range, it is what? Range structure. Okay. Most times when you see price form range structure like this, we are not expecting a deep pullback anymore. Most times we are not expecting a deep pullback anymore, especially when we have distance and movement. Okay. I promised myself I will not talk too much about those concepts we are not visiting yet. But then bear in mind that a range structure is any structure outside of the range. An internal structure are structures inside of your range. Okay, the major liquidity are liquidities that should not be violated. While the external liquidities are liquidities that we expect price to what? Take out. Major liquidities are respected. External liquidities are what? Expected to be taken out. Okay, so that's a quick recap of what I have explained this evening. Any questions so far, so we can make progress? I want all our videos to be within 40 to 45 minutes so they can be easy to understand, and accept. It is stressful watching very long videos. Okay, so question. Any question? Any question? No question. All right, that's great. Tomorrow we should be dealing. Tomorrow is Wednesday. All right, tomorrow we should be continuing with the characteristics of major liquidity. Okay, I think there are a few things, there are still lots of things on structure we'll be talking about. Now, the concept of liquidity is still inside of structure. I cannot talk about liquidity without structure and structure without liquidity. Okay, because everything that happens in structure is the creation of liquidity. Now, if you understand what I said earlier, that liquidity rests above and below every lower high and lower low, or higher high and higher low. It's just that there may be expected liquidity or respected liquidity, major liquidity or external liquidity, but the liquidity everywhere in price. All the highs and lows have liquidity. Okay, so the concept of inducement will be the last topic we talk about. Okay, so tomorrow I will talk about how to identify major liquidity, which will lead us to market structure models or price entry models. Okay, and then a day after that, or as we make progress, I will talk about points of interest, identifying points of interest. Or before points of interest, we'll deal with demand and supply and other blocks, so we can know what our point of interest should be. Then we talk about IFCs or SCs and the rest of all of that. Okay, so I believe we are good to go.
Yes, sir.
Yes, sir.
Yes, sir.
Thank you very
Thank
much.
you, sir.
Then tomorrow.
Thank
good
you,
evening,
sir.
Yeah. All right, guys. You have an amazing day. Bye.